Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, October 27th, 5:52 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. A little late tonight as there's a lot of after-hours action with some big earnings reports that impacted the indexes, some of our holdings, and I've got a lot to go through, but let's dive right into it. Market state in a correction, still hanging around minus 20% bear market category year to date, but a short-term uptrend since the O'Neill follow-through day from last week. You can see over here on the trend gauge, we've got market leaders under bullish / uptrend. There have really not been a shortage of breakouts, of earnings gaps, of positive reactions to earnings. Of course, there's the occasional landmine in there, most notably from some of the top NASDAQ 100 stocks, and another one after hours today. Short term, this is these 3 time frames. This is how we gauge the 5 major indexes, and after all, 75% of stocks follow the market's lead. Short term, using our 21-day exponential moving average, 4 of the 5 above there, but we did have a break of the NASDAQ 100 below the 21. So you see the red arrow pointing from bullish towards neutral. Medium term, the 50-day moving average flashing downtrend. But with the green arrow, as we've got 3 of the 5 indexes above the 50, 2 of them hanging on barely. Actually, 2 of them hanging on barely, one of them strongly above despite a negative reversal today. Long-term, 200-day moving average, all 5 major indexes below there. The Dow came within 1% of its 40-week today, not quite the 200-day, but the 40-week. And that has been the leading index over the last 3-4 weeks. So what happened today? Once again, S&P 500 failed at the 50-day moving average, and to pour salt in the wound, the NASDAQ 100 broke below the 21-day exponential moving average. Here's the rundown. G6 down 1/3%, S&P 500 down 0.6%, NASDAQ 100 down 1.8%, Dow up 0.65%. Bunch of positive earnings reports from quite a few Dow components overnight led that rally. Mid caps barely up, Russell 2000 up 1/10, global diversified 60/40 stock bond down 0.1%, in-house our GROTECTION portfolio down 0.51%. We did sell some UPRO after hours, so this might look slightly worse, but it doesn't account for something for the hedge that we have that is up after hours. So maybe down 0.55, 0.58, something like that. But at the close, it was down 0.51%. Let's get into, we'll get into the tail of the tape and charts of interest. But first, a quick primer on how we do what we do at Revere. First of all, why do we do what we do? Why not just put everybody in a pie chart and take it easy like the rest of, like 99% of the rest of America's advisors do? And quite frankly, we've had some negative experiences with family members and friends that had their money put into pie charts and not watched closely, and they got torn apart in the tech bubble when it burst in 2000 and 2002, and the financial crisis from 2007 2009. Starting in 2002, I made a commitment that I wasn't going to lose my hard-earned money. And then after 2007 2009 happened again, I got even more interested in running or working at an asset management company that was going to protect the downside. And I'm very fortunate to have come across Danny, and we joined forces, bought the asset management arm from Noram Capital, and our message has resonated very well in the 6-7 years I've been there, and we've managed to grow our assets. People like knowing that their downside is protected. They also like knowing that when the market goes up, you participate in uptrends. We're not just crying the sky is falling all the time, but when the sky does fall, we want to get the heck out of the way. Here's 13 bear markets since 1970. The worst of them average 44.5% on the downside. You need 80% to get even. We don't play that game. We have tools and technical indicators to get us out. We also have them to get us back in. Here's a look at a healthy market. Last October, November, market trending above the short term green line, that's the 21-day moving average, the medium term red line, that's the 50-day moving average, the long term black line, and they're configured lower, above medium, above long term. At that point, we have as much of our money in the market as we are comfortable having in the market. And if things start to go sideways and roll over, our stops will get hit. We'll take a little bit out. If things really start to roll over, the slopes of the line of the medium term and the short term will start to roll over. We'll get even more defensive. And if we break below this black line, that's the 200-day moving average. Every single one of these 13 bear markets has taken place below the 200-day moving average. On average, from the high to the break, a weekly close below is a loss of about 12%. It usually varies from maybe minus 8% to minus 13%. On average, it's minus 12%. Being down 12% is not that difficult to come back from, but double that or triple that. Now you're really talking about a serious problem. That's why we get maximum defensiveness when we're below the 200-day moving average. And sometimes the index can go into a free fall when you're below it. April 21st was a key day, led to a big leg down after some negative economic data. We had a little bit of a rally off the low here, and we use our tactical indicators to get back in on these short-term trends, take advantage of them, and then our stops get hit if we start to roll over again. Right now, we've been long since this big shakeout on a tactical basis, got above the 21-day moving average, put some more money to work, ran into the declining 50-day moving average, took a little bit off the table over the last couple of days with a hedge, and after hours today with a sale of some of our long positions, our long index positions. That was sparked by the sell-off in Amazon, which was down as much as nearly 20% after hours. It's cut it a bit to down about 15%. But right now we're still, after hours, still a little over 1% above the 21-day moving average. That's the green line. If that holds, we'll continue to maintain positions in the market, and we'll keep our stops in place for the individual stocks that we own. There are some leaders that are acting well, but again, there are a couple of landmines, and we did get hit with a minor one today. Although we only had a 3% position, we got stopped out for our 7% loss, and that's part of doing business. It's part of the game, accepting the losses, not hoping that things go back up. So there's the S&P 500. You can see today, after reversing at the 50-day yesterday, failed into the 50-day again today for the second straight day. Let's go to the NASDAQ 100. This one's quite a bit worse. Breaking below the 21-day exponential moving average and down another percent. This was down nearly 2% after hours. Cutting it to 1% is frankly a win for the bulls. Ideally, we want to get back above this 21-day moving average. I'm not holding my breath for that, but we've had Meta get torn up, Microsoft, Amazon, and Google. Tesla has recovered from its earnings sell-off, and Apple, it was all over the place after hours, was down as much as 5%, up as much as 2%. It's right around the flat line now, maybe up 1%. So maybe Apple saves the market. If a bunch of money flows into Apple the way it has been into Netflix since its good earnings report, that's just managers moving money around from poor earnings reports to positive earnings reports, and it happens all the time, and we keep our eye on how that money's flowing. Now, the strongest of the index is the Dow Jones Industrial Average, which normally leads during downtrends and lags during uptrends. But the Dow is, here's a typical example of, here's the relative strength on the Dow heading higher while the market's coming lower. That just means it's losing less than the S&P 500. But here you see during this recent run up, the Dow really has taken the bull by the horns and led. So it's got relative strength and price action. First one to get above the 21, first one to get above the 50. Trying to be the first one to get above the 200-day moving average. You can see where it came close to it today, even closer on the weekly chart, but very clearly the Dow leading, and it won't get hit at all with the Amazon pullback because Amazon's not a Dow stock, and Apple is, and actually the Dow down less than 0.2% after hours. So Apple saving the indexes and certainly helping the Dow, along with a bunch of good earnings reports from Dow components over the last week. Also, let's go to mid caps. Mid caps, two closes above the 50-day, closing at the low of the range doesn't really inspire confidence, and the downsloping line, of course, isn't a plus, but we take what we can get in this market when you're looking for the positives and we balance them against the negatives. Here's the small caps kind of looking the same way. Close at the low of the day for the second straight day, two closes above the 50-day moving average. Those are the 5 indexes. Now let's take a look at some other key charts. TLT up again for the third straight day. That means yields down. Above the ADMA coming into the declining 21. It hasn't been above the declining 21-day moving average since the beginning of August. So getting above there would very clearly be a change in character. For now, it's just a counter trend bounce. UUP, the dollar, had been a headwind for quite a while. Now two closes below the 50 or right on the 50-day moving average today, and the slope of the line is higher. So we need to watch this after 3 out of 4 big down days in the dollar helped out the market. Let's look at the VIX. VIX with a second close below the 50-day moving average. That's a plus for the market coming into the 200-day moving average and also coming into this 24 to 26 area where it's kind of the dividing line between being helpful and being harmful to the market. But definitely this move down from 35 to 27 was a tailwind for the market. Let's look at Bitcoin BITO, which tried to break above some resistance yesterday. We're going to go to a 60-minute chart on this. Second close above this 12.5 level, putting in a little bit of a flag here. So Bitcoin holding up pretty well. Certainly, Bitcoin was really in sync with the NASDAQ 100. Now it's taken the lead versus the NASDAQ 100. And putting in a flag here after this move up from 12 to 13. So we'll keep an eye on this. In fact, while I'm thinking about it, let's set an alert at 13, which would be a break above short-term resistance for Bitcoin. Let's take a look at gold. Here you see gold between 154 and 156, kind of in an uptrend over the last week and a half. Let's go to the daily chart, and it's hanging around this 21-day exponential moving average. It's been below the 50-day moving average since all the way back in the end of April, except for a couple of days here and 1 day here. A move above the 50-day moving average would be a big change in character for gold. Now let's take a look at some landmines that hit the market today. One of the leading silicon carbide stocks, Wolfspeed, with a big gap down, ended up down 18%, was down more than that, actually below 80 at one point. They're having supply chain issues, which is delaying them coming online with some product that was needed. And it very clearly got hit. Closed near the top of its range for the day. Now, if you are familiar with my gap rules, maybe this got rid of all of the sellers and this put in a bottom. That's normally the indication when you see a hammer type candle like this. So if we hold the low, it's obviously positive. We want to see what happens when we come into the 200-day moving average. You see I've got the next alert set near the 200 for that. That also affected AEHR, which we hold. They make test kits, and Wolf is one of their big clients. Gap down on this, but closed near the top of the range and reclaimed the ADMA, and we added 1% to our AEHR position today on this. It also impacts ON Semiconductor, which is similar to what Wolf does. Broke below, gap down after a close above the 50-day moving average, gap down, but did hold the 21-day moving average, and they've got earnings next week. So those are the three big silicon carbide stocks. Now, another one that we got stopped out on today, and as I said, there are some landmines in the leaders, and definitely Shockwave was one of them. So no, and earnings in 2 weeks for this, but a big move above this 50-day moving average on Tuesday, followed it up on Wednesday, actually trying to break out above this 315 level. Reversal along with the market yesterday, gap down at the open, no explanation that I could see. Broke the 50-day, broke the 21-day. We got stopped out for our maximum 7% loss on 3% position. Basically 0.2% impact to the portfolio on any single position. That's where we try to keep it, and that's where we were on Shockwave. Let's take a look at a couple of other key charts. Now here's Amazon, which hadn't been leading for a while. Gap up on its last earnings report, ran into the 200-day moving average, split. Where did it split? Back here, and had run up after the split after a little bit of a sell-off, but the 200-day was too much. Sellers come in. You can see the spikes on this chart are selling spikes, not buying spikes, and now down only 13% after hours. It was under 90 at one point, which puts it all the way down here, breaking lows for, geez, who knows how long we go back. Certainly anything this year. We'll see what happens if this comes up into the 100 level, the Livermore level, to see what happens with that. But that led to initially some sell-off in the indices. This is when we took some of our UPRO off, and for a small loss on that, but the hedge that we have went up, so it kind of offset the loss, but we did want to reduce risk after that happened. Let's take a look at the Apple chart and see where we are right now. And up 1.5%. This has been all over the place. It was down under 140, up to 148, back below 140, now above the close. We want Apple above the 21-day exponential moving average. Meta got absolutely slammed. This is not a leader. It's not it really. We've gone from tracking the top 7 in the Nasdaq on a constant basis to really not caring as much about Nvidia and Meta as their combined market caps don't match the next highest market cap, which was Tesla. But you can see this gap down today. Zuckerberg not cutting spending. They're going to lose a bunch of money putting it all into the metaverse, and it's probably going to make or break the company. You can see down 25% here today. Let's follow up on two of the big NASDAQ 100 stocks that had negative reactions to their earnings earlier in the week. When you see a gap down, you don't want to see it make a lower low. Google did just that today. So a second day lower low, not a good sign for Google. Yearly lows. Microsoft was the other one that had a negative reaction, and a second day lower low for that also, but didn't take out the low of 1013. So I guess if you're looking for any reason to be optimistic, there is one for Microsoft. So basically, and then the next of the big NASDAQ 100 stocks, Tesla, you can see after its gap down, it's reclaimed all of the loss, ran into the declining 21-day moving average today. That's where we want to see it get above for it. So a little bit of a light at the end of the tunnel, and the fact that the Twitter deal is closing tomorrow. Musk apparently didn't have to sell any more stock. That might be a tailwind for it. So it's possible that Tesla, Netflix, and Apple will carry the torch of leadership for the NASDAQ 100, which has been underperforming in a major way, especially relative to the Dow Jones Industrial Average. Let's take a look at the tail of the tape, and then we're going to talk about the portfolio buys and sells that we did today. So technical indicators, NASDAQ 100 is an exception to this. We're seeing positive news from the other 4 indexes. Put call at 1.08. VIX is not at 0.39. It is at 27.39. up slightly on the day, and it's below the 21 and 50-day moving average. Fear and greed ticked up to the mild greed level with a +2, still operating under the bull case as long as the rally stays intact and we hold the 21-day exponential moving average. Some news this morning: Q3 GDP firmly positive, so any more talk of a recession, being in a recession right now for Q3, put on the back burner, as Q3 GDP up 2.6% versus 2.4% expectation. I talked about after hours, Amazon down 15%, Apple all over the place, now slightly up. Second day down today from our day count perspective. My expectations were positive coming into today. After a day down, after a couple of good days up, but a negative second down day today, and sitting at this key 3,800 support area, which we really need to reclaim tomorrow. We're at this support range, as I said, on the S&P 500. We failed at resistance today. Today's high, 3860, which is right around that 50-day moving average. Broke support on the NASDAQ 100. Bonds up today, which means rates continue to fall. The dollar up today. Aerospace and defense, software, industrials, utilities up. Tech down. Gold stocks down. Biotech down. One thing to focus on are breakouts. Holding for the most part, yes, I've got a ton of them. Vertex and Schwab, though, two landmines in the we didn't look at Vertex, two landmines in Leaderland, and really for no reason. Vertex gapped down today and just continued to sell off, breaking the 21 and the 50. I think they reported after hours today. Vertex, where are you on my screen? You are 301. Vertex up 14 bucks after hours. So back above this 300 level. So for whatever reason, there was selling going into earnings. They reported earnings, and it's back above 300 after hours today. So good sign for Vertex. And then we talked about the VIX, the dollar, and the indices relative to their 21-day exponential moving average. So what did we do today? I talked about how we got stopped out on Shockwave. One of the big winners on the day, Impinj, PI, massive earnings gap up on huge volume. 730% volume, up 29% on the day, closed near the high of the day. This is what leadership looks like. You could argue that this is a big long cup with a high handle, or just the flat base part of the handle. Let's look at it on a weekly. And this stock is at all-time highs. That means that anybody that bought it has made money. If you're still holding it, unless you bought it to the penny today. But relative strength at a new high. This is the kind of action that we look for. We bought this morning around 110. And then around 112, 2%. It's on the thin side, but traded a heck of a lot of volume today. Averages 307,000 shares at $100 stock. So I've been talking a bit about how we've been looking to find ways into these slowly, mostly HLIT, AEHR, and now Impinj. Building our profits up and adding at low risk entry points, mostly near the 8 EMA. It's been working, and we don't want to get our position overweight enough so that we have to sell it into have a liquidity event when we're trying to get out. So we added Impinj, added 1% to AEHR, and sold 5% UPRO after hours. So bottom line, S&P 500 rejected again at the 50-day moving average. Test the 21-day after hours on the Amazon miss, but still above the 21 by at least 1%. Let's take a look at support and resistance levels here now. Here's the key one that we're at right here between this 3,800 to 3,815 area. This needs to hold right around it now. The next area down was what we reclaimed back on 10/21, this 3,715 to 3,730 area. I believe that is about it for today. So As always, love to hear your feedback. Email me, don@revereasset.com, or email dan@revereasset.com. That's Revere President Dan Stewart. He's a CFA, king of all things financial, Mr. A to Z when it comes to that topic. Or you can call us 855 Real Wealth. That's 855-732-5932. So wrapping up, Thursday, 10/27, and the last of the big earnings reports from the big NASDAQ 100 tech stocks. Certainly on the negative side there, and the NASDAQ 100 responding accordingly. So wrapping up Thursday, 10/27, this is Don Vandenbord reminding you, it's not how much you make in the market, it's how much you can keep. That's why we make risk management our number one job. The gains will take care of themselves when the market is in an uptrend and you're compounding from a much higher capital base than if you sit through major sell-offs. So just telling it like it is here at Revere. Thanks for listening and have a great day.